Risk appetite has faded lately, leading equities and energy commodities to peak early March. That follows nonetheless a strong quarter for risk assets. In Q1, the MSCI World was up 5.5% in the context of strong business and consumer confidence and strong corporate earnings expectations for the S&P 500, according to Factset. Meanwhile, fixed income staged a comeback, especially since the mid-March FOMC meeting, which managed to sound dovish while the Fed hiked interest rates. The environment proved supportive for hedge funds. The Lyxor Hedge Fund Index was up 0.5% in March, fueled by fixed income strategies. On a year-to-date basis, however, event-driven managers lead the pack, up 2.5%. Improving returns of alternative strategies and rich valuations, especially for US equities, have led to strong inflows into alternative UCITS. The asset class in Europe received inflows up to 10 billion euros, according to Morningstar, benefiting especially multi-strategy, fixed income arbitrage, and market-neutral long-short equity managers. In terms of positioning, it is interesting to note that global macro managers have significantly increased their exposure to European equities. Their exposure to the asset class now stands at a 5-year high, which is quite significant. In parallel, CTAs cut positions on commodities, especially energy and agriculturals, in a context of strong crude stock building in the US. Going forward, we believe that event-driven strategies remain highly attractive. Their exposures are currently balanced between cyclical and defensive sectors. CEO confidence is at a decade high, which is likely to translate into stronger corporate activity. And some elements of the fiscal reform in the US are likely to be supportive for the strategy. In particular, sectors such as telecommunications or consumer staples are likely to benefit more from this reform because they currently pay a higher effective tax rate than other sectors, and they rank high in event-driven portfolios. Finally, the newly appointed chairman of the Federal Communications Commission has advocated for a light-touch, free market approach to regulation, which is likely to be supportive for event-driven managers to the extent that the environment is likely to be more predictable and less sensitive for deal breaks.